Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz, powered by CNBC TV 18 Season 3. Today we are at the Mumbai head office of the pioneer of packaged drinking water in India, Bisleri.
Bisleri is renowned as the pioneer of packaged drinking water in India. The brand's constant innovation, commitment to quality and focus on customer need has made Bisleri the benchmark for bottled water in India. NSE FinWiz visited the office of Bisleri in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning.
And I'm joined by my two very special experts. We have Hemant Rustagi, who's the CEO at Wise Invest Advisors. Welcome to the show, Hemant. And we have Gajendra Kothari, who's the MD and CEO at Etika Wealth Management. Welcome to the show, Gajendra.
Thank you.
And our core topic for today is real estate. Gajendra, so first question to you. Now, real estate, very precious. Everybody wants to own real estate. But we're in Mumbai where the sky is the limit and beyond. I mean, space is the limit of the prices of real estate. How do you advise people who say they want to own a home? What's your advice to them about how they can go about owning a home in Mumbai currently with the prices where they are?
No, it's a very valid question. Real estate is the first love of most Indians. And particularly in Mumbai, you have many people who have come from outside and are working in Mumbai. So Mumbai is not their native place. Of course, they don't have a home. So they start with a rental place and, they have a lot of pressures from the family, friends, peer at work, that you should have your own place. But I would rather suggest them that, you should not buy real estate in the first 10 years of your career.
Okay.
Particularly if you're working. I mean, it's classic. I mean, I'm not from Mumbai. I came 10 years back and I didn't buy a house in the first 10 years. Because in first 10 years, you will undergo many job changes. And my office was early in Andheri and then it moved to town and then again it moved to BKC. I can't go on shifting my house, if it was my own house. When you're on a rental house, you can move around easily. So that's one good thing. Then second, over a period of time, you'll get married, And of course, when you get married, you don't want to be too close to your in-laws. And you don't want to be too far. You cannot be too far also. So once you are there 7, 8, 9, 10 years, you've seen Mumbai, you've known the places, then you can decide, zero in on an area which you like and you are comfortable, and then you can go ahead. So that's the first thing. And the second thing from finances point of view, when you just started, your salary is low, your EMIs form a huge part of your, job. You don't have job stability also in the beginning, so you can't take too much of a risk. And one issue is that, when you have a huge burden on you right from the beginning, you tend to become risk averse then. You don't want to leave your employer and you just stay there and you don't grow in that process also. That's another issue with that. So my sense is that wait for 10 years and then you will be able to buy a better place. You'll have a better budget because then your spouse is also working. You'll have a higher corpus at disposable to pay off EMI. I think that's a good time.
Okay. Hemant, people would want to know that how do you predict the appreciation of a real estate property? There is no short way to do that, is there?
I think we generally go by examples, what we hear around us. And that kind of becomes a benchmark. We find that, people telling us that I've made so much money from property. So we get kind of fascinated by that and we start investing in buying properties there. So clearly, there are so many factors that you need to consider when you're buying a property. It could be the location, it could be the builder. Many a times, you buy a house where you feel that it's cheaper, but when it comes to reselling, you are not able to resell because the builder doesn't have a good reputation, the construction quality is not very good. So, when you make this kind of compromises, you realize that you're stuck with a big investment and you can't really get out. So I think these are important things that investors need to keep in mind. There's always a fascination for real estate because like I said, we keep hearing stories, okay, I've doubled my money, tripled my money. But the fact is that in real terms, if you really look at annualized return, and if you were to compare that with maybe financial assets, you'll be surprised that the financial assets have given you always much more return. And the reason for that is when you buy a property, you don't sell it for 15, 20, 25 years. When it comes to financial assets, every 6 months, 1 year, you want to look at how it is doing. Should I be making some changes? We don't allow investments to grow. Yeah. I think that's one reason why we always feel that real estate gives much higher return, but which is not the case always.
Gajendra, if you could answer this question. This question is from Dipali Thakkar, and she says, how and what is the right age and money required to invest in real estate?
So actually there is nothing called a right age in the sense, as I mentioned, to each its own actually. You have to see in life, where are you right now? Is your job kind of permanent now? You are going to be in this area for long term, then only you think, If you're moving places then, and you're not stable in your career, then it doesn't make sense to commit yourself to such a large investment. So when you realize that, you've settled down, you've identified a good place and everything, and it is within your budget. So normally when we say it's in your budget, most of us, buy a home on a loan. So you have to consider that your EMI portion of the loan is not more than 30 to 40% of your take-home salary. Because then if it is higher than this component, then you'll have to, compromise on many other things. And you have to live under quite pressure, So if you are able to satisfy these checklists, the conditions, I think then you're good to go to buy a house.
On that note, it's time for a very short break. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3, and today we're shooting with the employees of Bisleri.
Nowadays you will see that investment in rural areas, people are there are many properties lying at rural areas. People are suggesting to buy those properties.
Okay.
So is this the right investment or the wrong?
Well, if you're saying that the properties are being recommended in the rural areas because they're cheaper, okay, you clearly need to look at whether it really suits your requirement. If you're looking at investment means you should be able to sell when you want to sell. You also need to look at whether it is going to be sellable after some time. So don't, as I mentioned earlier, don't go by only how much you're paying right now, because that may not be the right strategy. Instead, in fact, it makes sense at times to pay slightly higher, buy a property built by some reputable builder and which has the market. So clearly look at, if you were to sell a house tomorrow, whether you'll be able to sell it or not. So I think these are the factors you should look at, rather than just looking at whether you're getting something cheaper in the rural area, because it may not have the secondary market there. So if you're not able to sell, then the purpose of making money on that will be defeated.
How safe is to buy a property which are being sealed by banks?
A very good question. Of course, if the bank has taken the custody of the property, one good thing is that it's a distressed property, and bank is not in the business of selling and buying. So they would ideally want to dispose it off as soon as possible so that they realize whatever the value is. At times you get very good rates. The best thing about buying those kind of properties is that the title is very clear, because bank has done the due diligence and bank has got the custody of all the papers. And they're very good with these documentation part. So at least you can be safe about the counterparty. There's no counterparty risk in that. Now, then it depends on they do online auctions, these banks, and it depends on the demand and supply again. If there are too many buyers looking for that kind of property, they give ads in the newspaper and stuff. I'm sure not only you are watching, everybody else is also equally watching. So, so you have to be careful. I mean, how much you can afford that. Again, there's no fixed price there, there's a base price, but it can go up as high as possible. So you have to have a cutoff limit until you can afford, But in terms of quality, I think these are good properties actually, yes.
Recently, we've seen a lot of articles saying that the top properties in Mumbai also have a lot of vacant flats. People are not buying and they're just lying vacant. Do you think over the years it is going to lead into a slowdown or a downfall in the prices of real estate in Mumbai?
Well, I think in terms of whether the price will correct or not, clearly we're already seeing that prices are under pressure. I think it depends on which city are you planning to buy. In the smaller towns, we've already seen that there is a pressure on the price. The prices have come down. In a place like Mumbai, of course, because there is a paucity of land, and even though there are flats vacant lying in the prime properties, but the fact is the builders do not want to bring the price down to a certain level. And if their capacity to hold the prices, they will hold. But I'm sure over a period of time you'll see the price correction, but the correction will vary depending on at which place you want to buy. So first thing, I think you should not be waiting all the time for correction. Okay, you should be looking at whether you can afford to buy one, because it all depends on where you want to buy, what is the current price. And if you're planning to buy in a locality or in a city where you're already seeing a trend of correction, maybe you can wait for some time. And in any case, we're already seeing if you're planning to take a housing loan, the interest rates will come down further. So maybe you can wait for some time and then start. Because don't forget that it's a house that you're buying. If it's your first house, that gives you security. It's a necessity at times, so you can't obviously be timing it, at all times. But if you see a clear trend emerging in terms of price and the interest rate going down, maybe it makes sense to wait for some time and then plan for your buy.
Hemant, there is another term that's associated with mutual funds is SIP. What is SIP? And there's also SWP. Could you shed some light on these terms?
Well, yes, I think let me begin by explaining what SIP is. SIP is Systematic Investment Plan. Many investors think that it's a product. It's not a product by itself. It's just a mechanism that allows you to invest on a systematic basis. We all know about recurring deposit. What happens? You give a mandate to the bank saying every month, okay, debit my account by X amount and put it in the recurring deposit. Exactly the same way SIP works. You give a mandate to your bank that I've chosen these 2, 3, 4 funds. Every month you take out this money and give the money to the mutual fund. The mutual fund in turn will invest in the fund that you have already chosen. The biggest advantage of that is it brings in discipline in your investment process. The 50% of your investment success will come only from if you follow a discipline. Now what happens if you don't follow discipline? That if the markets are doing well, you'll be tempted to put money. If the markets are going down, you'll say, let me stay out of it. Whereas that is the right time for you to be investing in equity. When you sign up for an SIP, what really means is that you're committing to invest a particular amount on a particular date in a particular fund. So it brings in a lot of discipline. Now, especially when you invest in equity funds, equity we all know has a wonderful potential to give you a return over a longer period of time. But in the interim, in the short term and medium term, it tends to be very volatile. So how do you tackle the risk of volatility? Many times we stay away from equity because we feel equity is risky. It's risky because of the volatility risk. When you invest through SIP, okay, let's say you're investing in 3 funds or 3 different dates in a month. The volatility means that you're investing at different level, which means your average cost will come down. So you actually benefit from the volatility rather than worrying about it. So it brings in discipline. It allows you to invest at different levels. But let me also clarify that SIP is good not only for equities, it's good to invest even in a liquid fund or a debt fund. Because any product of mutual fund is a market linked product, which means there is going to be some amount of volatility. So SIP is a great thing. SWP is systematic withdrawal plan. Now what it means is that either you have accumulated a corpus, for example, we're talking about retirement planning here. Let's say if I'm investing for 25, 30 years, I have accumulated a corpus. Now I want to generate income. But the problem with the mutual fund is because they're market linked products, that return, monthly return can vary, which you can't afford. So how do you make sure that you don't have an amount which is coming different every month? You opt for a systematic withdrawal plan. Now what happens is, if you build a corpus for 15, 20 years, all that has become tax-free. What you do then, you tell the mutual fund that every month I want to withdraw 25,000 rupees. They will automatically redeem that money and give you. See what has happened? You have converted everything into tax-free, and then you've kind of assured yourself that you are getting the money that you need to get every month. So both these processes are not product by themselves, just a mechanism, and should be used by every investor depending on at what stage of life you are.
On that note, it's time for a very short break. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. How do you choose a good mutual fund? Because in the case of, say, fixed deposit, usually I'll go for the fixed deposit in which my savings account is. Or you might say, okay, PSU bank or a private bank, this is X is offering 6%, others offering 5.5%, whatever. But in mutual funds, it's more complicated because there are so many more mutual fund schemes. What's your advice? How should they be able to pick the best mutual fund for themselves?
Right. As you rightly said, fixed deposit is a plain vanilla product. In each bank, there are certain rules, and the only thing to compare is the rate of returns, on the fixed deposit. Mutual fund is a different game altogether, and there are so many options and so many plans, growth, dividend reinvestment. As a retail investor, it's too much overwhelming for you, First thing I always recommend, go through a financial advisor, because you are, you're working full time as an employee and you have certain strengths. It's very difficult for you to spend time and research and analyze all of these things. So if you don't have time and knowledge, go through a financial advisor. He will guide you based on your requirement. However, if you want to do it yourself, okay, then Again, you have to come back to, now there are 48 mutual fund companies in the country, and each one says I'm the best. You see hoardings all over, my fund is the best, and 5-star rankings. I think, I'm sure you see all these things. There are a few things which you have to analyze before choosing a scheme. First is the track record. Why do we all like Sachin Tendulkar? Because 30-year track record, consistency. So see how long has been the fund for. If the longer the fund and it has a consistent history, I think that is one good thing. Most people do make a mistake that they go through the new fund, They see the hoardings and they say 10 rupees may NFO, they buy the fund because they think it's cheap. That's not a good idea. So the older the fund, the better it is, because then you know the track record of the fund manager. That's the first thing. Secondly, not only just the track record, you need to see the consistency also, How, I don't want a fund which was number 1 last year and number 300 next year, because then it's too much volatile. Even if he's not the best, but if he's able to beat the competitors and on a stable basis, I would like to go for a fund. So these are a couple of things. And one thing, third thing you should look at is the expenses charge. See, at the end of the day, the fund manager is not doing charity, right? He's running his own house. So there's something called expense ratio charge to a fund. In an equity fund, on an average, you pay around 2 to 2.5% every year. So when you invest 100 rupees, 2 rupees to 2.5 rupees every year is deducted from your portfolio. And it's dependent on the value of the fund, okay? So that the higher the charges, the lower may be the returns. So these are few factors, basic hygiene things, which you must look before you commit your money into a fund.
Okay.
What are the major factors, basically, 3 most important factors to be considered while the person is trying to frame his financial goals?
I think one of the most important aspects of your investment process is setting your goals. Many a times we have these goals, we vague idea, we don't actually put them down. Now, all of goals are what basically your requirements. What it means is, what do you want to achieve with your money? Okay, you will have certain goals, and the goals has to be such which you can convert it into money, which you can find out how much money you require. It could be a vacation every 2 years or every year. That is your goal. You want to buy a car, that is a goal. You want to buy a house, that is a goal. You want to plan for your children's education, that is a goal. You want to plan for your retirement, that is a goal. Or you can have some other goals. Now, all of us will have so many goals, right? Why it is important for you to list down all your goals is, that's the first process. Then you will see how much money is required to achieve all these goals. As I mentioned earlier, you need to set a target, time horizon, work backward on certain assumed rate of return. Now, for example, when you are investing in equities, there's no guarantee how much you will get, but we have seen that over a period of time, when you invest for 15-20 years, you can at least get around 12%. So based on that, you work backwards and see how much money will you require to achieve this goal. Now, for example, if you want to create a corpus of 5 crore for your retirement, how much money you need to invest every month over the next 25 years. So once you've done this process, you know how much money is needed to achieve all your goals, right? Then you go back to your income levels. You see how much money can you spare. Suddenly, if you require that, let's say 30,000-40,000 rupees every month, and you can only spare 20,000, you need to prioritize your goal. Which goals are more important for you? If you feel that I can wait for retirement for another 5 years, I have more important medium-term, short-term goals, focus on them, right? So this process will help you prioritize, okay? Because then you have to make sure that your goals are realistic. All of us will have aspiration, dreams, but they have to be manageable, right? How do you do that? Looking at your income, looking at what you need. Now, what this process does for you, you may focus on short-term and medium-term, but you have it at the back of your mind that whenever my income levels go up, I need to start investing more for my retirement. Okay, so it's a very simple process. It's not a very complicated process. What it requires is some kind of discipline, some kind of plan at the beginning. And discipline is very important, because if you're investing for the next 50, 20, 25 years, many a time we see the market goes down, we stop. Okay, whereas that is the right time for you to invest. So if you stick to your time horizon and continue this process, I mean, there is no way you cannot achieve any of your goals. So it's a simple process. It requires discipline. It requires some kind of planning. All the goals are achievable.
On that note, thank you so much, Gajendra. Thank you, Hemant. And thank you so much for being here with us.
Today's session was very good, and what we understand that every time we are in the doing our jobs, and we don't have a time to think about where to invest and how to invest. So this is, I believe, a good platform today. We got it a small session, but it is very learningful, and then really we can think about that. We can give at least 10 minutes for ourselves to invest our own money.
I think this session is really, really good, especially when you are a young professional who's just started to work. You really don't know where to put your money in. You just end up spending your entire salary. But when somebody really shows you and guides you on the path of how you can save your money and where you really need to invest, it opens a completely new door for you. And I'm sure I'm going to start investing from this one.
This was a very good platform for me to understand where I should invest my money, because I'm looking forward to invest my money in real estate, and this platform has really helped me to know how am I supposed to invest.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this question.
How should you select mutual funds for investing? New and exciting NFOs, promised returns, funds with long track record. Send in your answers at fwq@network18online.com. The correct answer to last week's viewer question is option B. It protects the loss of income due to critical illnesses. Many thanks to all the viewers who sent in their replies. The winner to episode 10's viewer question is Mona Shah from Mumbai.
We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.